In the quiet, climate-controlled corridors of East Setauket, Long Island, far removed from the chaotic shouting of the New York Stock Exchange, there is a ghost in the machine. It does not sleep, it does not panic, and it does not negotiate with the sentimental delusions of human traders. This is the home of Renaissance technologies, the fortress built by the late mathematician Jim Simons, a man who solved the market not by understanding the why of economics, but by decoding the violent, hidden how of price action. For 3 decades, the Medallion Fund has generated annualized returns of 66% before fees, a statistical impossibility that suggests they have found a flaw in the fabric of financial reality itself. But recently, the algorithms that power this black box models that digest petabytes of data from satellite imagery to shipping manifests have begun to scream about a specific anomaly. It is a signal that has not flashed with this intensity since the inflationary inferno of the late 1970s. It is not pointing toward AI stocks, sovereign bonds, or the crowded theater of cryptocurrency. It is pointing toward a forgotten corner of the periodic table, an asset that has been suppressed, manipulated, and ignored to the point of structural rupture. The models are registering a Stage-4 divergence event in silver, a condition where the paper price of the asset and the physical reality of its supply are about to violently divorce. To understand the magnitude of what the algorithms are seeing, one must first strip away the modern arrogance that assumes market prices reflect reality. They do not. In the case of silver, the price is a carefully constructed fiction, a facade maintained by the derivative markets of the COMEX and the London Bullion Market Association. However, the data buried in the footnotes of the Silver Institute's 2024 World Silver Survey reveals a terrifying arithmetic that no amount of paper trading can hide. For 4 consecutive years, the global silver market has run a structural deficit. In 2023 alone, the gap between what humanity dug out of the earth and what industry consumed was 184 million ounces. To put that number into visceral perspective, it means that every single day, the world consumes roughly 500,000 more ounces of silver than it produces. This is not a temporary supply chain hiccup or a logistical snag. It is a geological and industrial wall. We are draining the above-ground stockpiles at a rate that mathematically guarantees a collision, and the medallion-style models, which thrive on identifying unsustainable imbalances, have identified this as the single greatest arbitrage opportunity of the 21st century. The history of silver is not merely a history of money, it is a history of betrayal. To truly grasp the Stage-4 event we are entering, we must look back to the last time the world faced a crisis of confidence of this magnitude. The year was 1873, a date etched in infamy as the crime of 73, when the United States Congress effectively demonetized silver, ending the bimetallic standard that had served civilization since the Roman Empire. This decision, seemingly bureaucratic, was a coup d'etat by the banking elite, forcing the world onto a gold standard that was easier to control and scarcer to distribute. It relegated silver, the people's money, to the status of a mere industrial commodity. But history has a way of rhyming in the most brutal fashion. Just as the Coinage Act of 1873 stripped silver of its monetary crown, the current crisis is about the market, rediscovering that silver is the only element that bridges the 2 most critical drivers of the modern world: monetary protection and technological advancement. We are witnessing the revenge of the periodic table. Consider the Hunt brothers in 1980. The mainstream narrative, written by the victors and the central bankers, paints Nelson and William Hunt as greedy speculators who tried to corner the market. This is a lie, or at best, a convenient half-truth. The Hunts were not merely speculating, they were fleeing. They looked at the reckless money printing of the Federal Reserve under Arthur Burns, they saw the double-digit inflation eating the marrow of the American middle class, and they realized that paper currency was a burning house. They moved into physical silver not to manipulate, but to survive. When silver hit $50 an ounce in January 1980, it wasn't a bubble. It was a repricing of the dollar's worthlessness. The establishment responded not by fixing the currency, but by changing the rules of the casino. The COMEX raised margin requirements, explicitly targeting the Hunts, forcing a liquidation that crashed the price. It was a rigged game. But the signal the medallion models are picking up today is distinctly different from 1980. In 1980, the shortage was monetary demand. Today, the shortage is existential. The mechanism of this suppression is the paper short. In the futures markets, bullion banks trade contracts representing billions of ounces of silver that do not exist. It is a game of musical chairs played with high-frequency trading algorithms, where as long as the music plays and nobody asks for physical delivery, the illusion holds. But the music is fading. The registered inventory at the COMEX to silver that is actually available for delivery has plummeted by nearly 70% since the start of the pandemic. We are approaching what insiders call operational zero, the point where the vaults are effectively empty of deliverable metal. When this happened in the nickel market in March 2022, the London Metal Exchange was forced to suspend trading and retroactively canceled trades to save the shorts from bankruptcy. A similar event in silver would not just be a trading halt. It would be a systemic heart attack for the global financial system, exposing the fact that for every claim on an ounce of silver, there may be hundreds. of paper promises floating in the ether. We have arrived at the convergence, the precise moment where the unstoppable force of industrial physics meets the immovable object of monetary suppression. This is the two engines framework operating at maximum velocity. Engine 1 is the macroeconomic debasement. We are living through the greatest debt expansion in human history. The United States government is adding $1 trillion to the national debt every 100 days. The Congressional Budget Office's own projections show a trajectory of fiscal dominance where the Federal Reserve will be forced to print money to buy treasury bonds, lest the entire government's solvability comes into question. In this environment, silver acts as gold on steroids. It is the highest beta asset to monetary debasement. When the realization hits the general populace that the currency is being diluted to zero, the rush into hard assets will not be a trickle. It will be a tsunami trying to squeeze through the eye of a needle. The total value of all above-ground investment-grade silver is a rounding error compared to the liquidity floating in the stock market. If even 1% of institutional capital tries to enter the silver market, the price cannot merely double. It must geometrically expand to accommodate the inflow. However, it is engine 2, the industrial demand, that makes this specific moment unique. In 5,000 years of economic history, we are attempting to rebuild the entire global energy infrastructure, and the periodic table has imposed a hard constraint. Silver is the most conductive metal known to man. It is not optional for the green transition, it is fundamental. The photovoltaic industry, the makers of solar panels, has evolved. We are moving from PERC cells to Teopicon and HJT technologies, representing a generational shift in efficiency. But there is a catch. These new technologies require anywhere from 50 to 150% more silver per panel. The Silver Institute projects that the solar industry alone could consume 20% of the entire annual silver supply this year, a figure that was unthinkable a decade ago. Add to this the electrification of the automobile fleet, where every electric vehicle requires up to 2 ounces of silver for connections and battery management systems, and the proliferation of AI servers which demand high-efficiency contacts to prevent overheating. The collision of these two engines is creating a phenomenon known as inelasticity of supply. Unlike oil, where a higher price can prompt Saudi Arabia to open a valve, or corn, where a farmer can plant more acres next season, silver supply cannot respond to price signals in the short term. A primary silver mine takes 10 to 15 years to go from discovery to production. We have spent the last decade underinvesting in exploration because the suppressed price made it unprofitable. We are now harvesting the bitter fruit of that capital starvation. The mines that are operating are seeing degrading, or grades, meaning they have to crush more rock to get the same amount of metal. Mexico, the world's largest producer, is facing political instability and mining moratoriums. Peru and Chile are battling water shortages and labor strikes. The supply is constrained by geology and politics, while demand is being driven by government mandates and monetary panic. This is the definition of a Stage-4 event, a market where price has no choice but to go vertical to destroy demand. Yet the demand is mandated by the state's own green energy goals. It is a paradox that can only be resolved through a violent This brings us to the philosophical precipice. What we are witnessing is not just a trade, it is a judgment on the age of illusion. For 50 years since Nixon closed the gold window in 1971, the world has operated on the belief that value can be dictated by decree, that wealth can be printed, and that resources are infinite if the interest rates are low enough. Silver, with its dual nature as both money and machine, exposes the lie. It is the only asset that is simultaneously a monetary anchor and an industrial necessity. You can print a dollar, you can print a euro, you can print a bond, but you cannot print the thermal conductivity required to make a solar panel work. You cannot print the electron mobility required for a ballistic missile guidance system. Reality is reasserting itself. The Stage-4 signal from the Medallion-style models is essentially a warning that the era of financial abstraction is ending. We are returning to a world where physical things matter more than financial derivatives. The stakes for the individual in this transition are binary. There will be those who hold paper claims on wealth, and those who hold the wealth itself. The bifurcation will be brutal. When the nickel market broke, those who held paper contracts were given a settlement price dictated by the exchange. Those who held the physical metal held the power. We are moving toward a future where the counterparty risk of the financial system becomes the primary driver of asset allocation. Silver, sitting quietly in a vault, has no counterparty risk. It does not rely on the solvency of a bank, the honesty of a government, or the stability of the power grid. It is simply mass and energy, refined into a store of value that has outlasted every empire in human history. As we look toward the horizon, the convergence is inevitable. The deficits are locked in by chemistry and geology. The monetary debasement is locked in by politics and mathematics. The suppression of the price has only served to coil the spring tighter, depleting the inventories that once acted as a buffer. Now, the buffer is gone. The vaults are echoing. The industrial buyers are beginning to panic, bypassing the COMEX to secure metal directly from refineries, a behavior that signals the breakdown of the centralized pricing mechanism. The ghost in the machine at Renaissance Technologies likely saw this coming years ago. analyzing the subtle decay of correlations that kept the illusion alive. Now, the signal is screaming. It is a call to awareness that transcends profit. It is a reminder that in the end, nature always bats last. The artificial suppression of price creates the conditions for the explosive revelation of value. We are standing on the shore, watching the tide go out, revealing the ocean floor for the first time in generations. Unaware that the water must return, and when it does, it will reshape the coastline of the global economy forever.